I've invested about $18,000 into one single ETF. I just got to 150 shares of SPMO, which is Invesco's S&P 500 Momentum ETF. So why am I buying SPMO, even with all the volatility? There are a few reasons, including one major piece of international news that just came out and lets me know that momentum investing is growing around the world. We'll be taking a look at those top performing companies that continue to drive this ETF and more. So let's get into it. Let me share my results, how I built up to this 150 shares. I've been reallocating money in dollar cost averaging and buying the dip when it comes to this particular investment. And yes, I will be reinvesting those quarterly dividends, which isn't huge, but it does contribute. That compounding adds up when you stay consistent and let your investment build and grow. This one is definitely going to be one of those long-term holds for me to give my portfolio additional growth. So here's a look at my results. And I've only been building this position for a couple of months now. I'm currently up 1.54%, a gain of $274.96. And my total portfolio value is $18,100. I have an average cost of $118.89. I've been adding 0.1 shares to my portfolio, which comes out to about $12 on a consistent basis, whether the market is high or low. And then on those days when we have significant pullbacks, I buy full shares. For example, back on November 14th, I picked up 2 shares at $115.75. And on November 17th, 5 shares at $116.13. Now, for a quick refresher as to what is SPMO, it tracks the S&P 500 Momentum Index, which selects the top 500 stocks with the strongest 12-month performance from those companies in the S&P 500. It has an expense ratio of 0.13%, a dividend yield of 0.64%. It's basically an ETF that holds what's been performing well. It cuts out what isn't and keeps on rotating and adjusting to make sure that we have those top industry leaders when it comes to that momentum index, giving us exposure to those strongest names. And here's a look at those top holdings when it comes to this fund. We have Broadcom, NVDA, Meta, JP Morgan Chase, Palantir, Netflix, Walmart, as well as Visa, Oracle, and Cisco Systems. When it comes to this fund, in recent news, international news, I saw that QQQM, I believe you would pronounce it, asset management company in Korea has just launched their own S&P 500 Momentum ETF based on the same index as SPMO. It'll be listed on their exchange starting on December 9th, 2025. So I take this as a good sign. When big global firms copy an index like this, it tells you that there is real demand, and momentum investing is something that they want to have exposure to also. It's going worldwide. Now let's take a comparison to some other big funds. First, MTUM, which is iShares Momentum Factor ETF. In comparison to SPMO, it changes slowly. SPMO rotates faster. SPMO has captured stronger performance because it adjusts more quickly when those market leaders shift. Both track momentum, but MTUM is designed to trade its stocks less frequently. It has rules that limit how many stocks it can buy and sell at once. Its portfolio shifts more smoother, and its overall rotation, the turnover, is slower than SPMO. Then we have QQQM, which is Invesco's NASDAQ 100 ETF. It's a set standard lineup. It's going to give you exposure to the NASDAQ, those big tech companies. The companies in the index are going to basically stay unchanged. You're going to have very stable exposure to mega cap tech companies. So you're usually not going to see much changes unless their market cap changes significantly. There's a merger, bankruptcy, so a more consistent lineup, giving you, as I said, that constant exposure to primarily the same big tech names, while SPMO gives you exposure to the strongest performers right now. So you can see here the difference when it comes to expense ratio. I also put in there VOO, which is just our standard S&P 500 investment, just to show you how these other funds perform against the S&P 500. But overall, they all have an expense ratio 0.13 for SPMO and then 0.15 for QQQM, as well as MTUM, and modest dividend yields when it comes to these type of funds. And taking a look at the performance over the last 5 years, SPMO is up about 146%, QQQM is up 111, VOO is at 99, and MTUM is at about 69%. So we can definitely see that drastic difference between SPMO and MTUM, both momentum investments, but totally different methodology and way of tracking, and SPMO is winning in this department. So I've definitely seen the volatility when it comes to this fund, as well as times when it was just pretty much trading sideways. But I'm just getting started with holding this position in my portfolio, so I'm going to give it time for those tech stocks, healthcare, banking, whichever companies are leading the market, to continue to drive the performance for the long term, like we see looking back on the past 5 years of what SPMO has been able to accomplish. So what's my strategy going forward? I'm going to continue to build it up a little bit more, let those dividends reinvest, accept that momentum means more volatility, and that this fund may lag at times due to the market being flat. But we can see, even though it's not an extensive length of history, we can see that it does outperform. So it's fitting well into my strategy as being a long-term play. So this is a core position in my portfolio for additional growth, not just a basic S&P 500 or total US stock market investment. Let me know in the comments, which ETFs are you holding in your portfolio? Any of the ones that we took a look at today? SPMO, a fund that gives exposure to the S&P 500 like VOO, or QQQM for that concentrated exposure to big tech. And after you drop those comments, don't forget to make sure you like, subscribe, and hit that notification bell. Check out my referral links. Thanks for watching. Okay, bye.